we're looking between 8 to 12% on cap rates. With the boutique hotels, one of the biggest benefits that you guys have is you're able to operate it from remote, build that network of realtors, get into the right rooms, get into the right spaces. And a lot of the hotels that I've bought are owner to owner. This is how it's managed. These are the expenses. This is what I know that I can cut the experience down. Crank the screws, make that 3 years down the line, say you're going to get to optimal efficiency. What are your numbers going to look like? What are the profits going to look like?
We in this thing dropping blue gems.
Let's go.
Let's
Another
go.
episode of Blue Gems podcast with Sujay Mehta, a hotel beast, our first hotel guy. Man, we're excited to have you on. What is your story? Tell the audience, the listeners that never heard it before. Super excited to have you, man.
Yo, I'm excited to be here. Blue Gems, it's a blessing. It's an honor to be up here with you guys. I've been so excited about this opportunity to kind of chat it up with you guys. So let's get into it. You know, my story, again, my name is Sujay. I'm from Columbus, Ohio. I'm a Buckeye at heart. I bleed scarlet and gray. So I know sometimes it's Ohio against the world. So not necessarily the most popular thing to say I'm a Buckeye, but it is what it is. So most of our properties are in Ohio. And the way it works is, you know, a lot of the short-term rental guys or people in the short-term rental space, you know, we talk a lot about boutique hotels and, you know, kind of having that no brand hotel, right? But what I do is a little bit different. I do franchised hotels. So a lot of times we see Hiltons, Marriotts, Hyatts while we're driving down the road. A lot of us have probably stayed in a lot of these hotels at some point in our life. But what I do is I franchise these hotels. We own the real estate, we own the operation, and we pay a royalty or a part of our gross revenue back to Hilton, Marriott, Holiday Inn, whoever the franchise may be. And so, you know, we have a portfolio of these hotels. We build them. We do acquisitions. We do a little bit of both. And, you know, depending on the time, depending on what's going on, our strategy is always changing. But we're currently building a couple right now. We're obviously always looking for acquisition deals if we can find good cash flowing properties. But, you know, that's really my story, right? So this is what we do. The full story is yet to be written. So, you know, that brings us here. So
Let's rewind for a second though, because you know, how did you even get into hotels? It's not something that you just like stumble up on. Like, how does one enter hotels? You know, normally the progression is like, I'll start with single family, I'll move into multifamily, maybe get some duplexes, quadplex, and then you move into hotels. But it sounds like you just started straight through hotels. So let's hear that backstory.
Yeah, no, I love how you set that progression up to multifamily because, you know, now with the whole Airbnb and the short-term rental game, there is that stepping stone. But, you know, kind of 10 years ago, there wasn't that stepping stone. And so, you know, my family is actually in real estate and my father actually got into the hotel business first. And for him to get into it, the level up or the progression wasn't necessarily to get into short-term rental or Airbnb because that didn't even exist. So what it was you get into kind of a little bit more of the economy brands. So, you know, the Days Inns of the world or the Motel 6s, and then you start leveling up your brands or your franchises. And again, you don't necessarily have to because even those are very profitable, high in cash flow, but it's a little bit different type of management, right? So once you get your foot in the door with those kinds of brands, then you can really start leveling up into the Hiltons or the, you know, Marriotts of the world and start scaling that business. So so how I started was, you know, I was actually, you know, I'm Indian.
We are thrilled to announce Blue Gems Management. After building out 24 short-term rental properties of our own, we're now helping other investors buy their time back. With over 300 five-star reviews, we really understand the importance of guest experience. If you're interested in making short-term rentals passive, click the link in the show notes below and someone from our team will contact you soon. Now back to the show.
I'm Indian. I'm sure you guys know a lot of Indian doctors, but had a lot of pressure from the family to be a doctor. You know, went into Ohio State as a neuroscience major, and then had a change of heart and wanted to go into the business side of it. So I actually went into the healthcare business. I opened up a few clinics, but while doing this, I was really seeing, like my family, what they were doing in real estate. They started developing, they did some land development projects, and seeing how much like freedom, flexibility that they had. And then on top of that, the profitability of that time, right? The time that they put in and the return that they get out of it. It was way more than anything else that I had seen, especially in like the healthcare, the entrepreneur side of healthcare. So, and legislations are always changing in healthcare. It was just so much to manage. It was so much headache versus what I was seeing in real estate. So then what I did was I started looking into real estate. Obviously, had my board of advisor. I call him kind of like a life advisor, which was my father. And, him and I went out and we started looking at different deals, found a piece of land, and we thought, hey, why don't we build a hotel on here? So, that's kind of how the whole story started. My first property or project was a development project, which I don't recommend to anyone at all because it was definitely tough. It took us 3 years to do that development project versus, now it takes us 18 months to do it. But basically, I mean, the point is like, if you've done an acquisition, if you own and manage, a property, it becomes so much easier because there's so much value engineering that you can do, for your development project. When you look at a hotel, you can say, hey, I want the bathroom to be here, or I want the lobby space to be a little bit bigger, or I want, an employee area here. Or, one example of something that we did was, this property, it was an 85 unit property. And what we did was we built laundry chutes on each floor. So the housekeeping staff doesn't have to go into the elevator, bring the linens down every time they're changing over the room. They can just throw it into the chute, falls right into the laundry room. And our laundry person can just keep crunching. They crank, they just pull it out of the chute, put it in the wash, and they're folding, they're drying, they're washing, and you lose that time lag between, stripping the room, getting it in the elevator, bringing it down. So when you have that kind of experience, you're really able to do value engineering when you're building a property.
So much to unpack there, but I think for me, being a financial guy, my first question is going to be, how does one go about figuring out whether or not a hotel is a good deal, right? A good buy. What are your target KPIs or returns when looking at a new acquisition?
Yeah, no, great question. At the end of the day, hotels, it's just another asset class of real estate, right? So when we're underwriting multifamily, a single family home, a short-term rental, basically what we're looking at top line revenue. We're taking out the expenses, and then at the end you get the NOI, right? And so similarly, when you're looking at hotels, you're looking at the same metrics. So NOI, ROI, IRR. Typically what we see for the expense ratio for hotels, it's about 65% is the expense ratio, and then 35% will come down to the bottom line. And then, with the NOI, we're typically looking, at a cash on cash return of about 8-9%, cash on cash return. And then, obviously you may be able to get a little bit more than that, but typically 8-9% is my bottom line. Usually we're able to, that gives us some value add opportunity to, do more efficient management, get it up to 10-11-12% cash on cash return every year. And then obviously that adds value to the actual asset. And on exit 5 years, you're able to maybe pull out, a 25% AAR. And, sometimes we've actually actualized like 31% IRR on our projects. So, definitely a lot of cash flow in the hotel industry. And that's the reason why I love it so much in comparison with other asset classes, which is really, more of a passive income or a passive stream of income versus hotels. You have so much cash flow. It's a business plus it's real estate. So
the 65% includes management fees as well, or do you guys manage in-house?
No, so typically management fees will be anywhere between 3 to 5%, depending on how much service that they provide. Typically, when we are underwriting our deals, we're looking at 65% with management fees included. And so, I mean, typically, if you're doing $2 million of revenue, even if you look at, 4% on average, I mean, you're looking at like $80,000. So usually you can bake that in there and still actualize in a 65% expense ratio. So
That's super interesting, right? Because JB and I have a management company. We charge 20%. So when I hear 3 to 5, I'm like, wow, they must have some good operations in place to hit their margins. But to your point, $2 million in revenue is a lot different than 50K on a single family home. So the economies of scale is benefiting them there.
absolutely, absolutely. And then, the other fact of that is, when you have a dedicated GM at the hotel, right? So you have one person who's going to be at the hotel, all the time, call offs, they're there to take that responsibility. And so when you have that kind of structure at every hotel, that stuff is baked into the payroll of the hotel. So, when you're talking about management, you have those kinds of legs to support you with each property. So with the management company, you're really able to scale a lot. And the 4 or 5%, really what comes out of that is kind of like the top line, the above property level management expenses that you would have. So
It makes
So
complete
yeah,
sense.
obviously this is a short-term rental focused podcast, and would love to hear some of the correlations or commonalities between hotels and short-term rentals.
yeah, I mean, honestly, there's so many. And it's funny because when people think of short-term rentals, they never think of hotels. But at the end of the day, fundamentally, we're doing the exact same thing, right? We're renting out our rooms on a nightly basis. We're adjusting our rates. We use dynamic rate change. We use all of these methods every single day. It's just what we're doing is we're doing it for 80 rooms at a time versus, Airbnb is doing it for a 1 or 2 or 3 rooms at a time. And so hotels are really just, it's a scale of short-term rental, right? So it's more units under one roof. You can afford to have, a dedicated staff under one roof, and it's getting paid for because you have the scale to, right? So your fixed costs get spread out over 80 rooms or 90 rooms or 100 rooms. So I think there's so many similarities. One of the biggest differences is the franchise component, but you take that out. And I think, the toughest part with short-term rental or Airbnb is kind of the marketing, right? And Airbnb takes over the marketing for you. You give them a fee. For us, it's Hilton or Marriott or Holiday Inn, and we get this whole group of people, right? Millions of people across the world who are just diehard, Marriott people or diehard Hilton people, right? When I go to Ohio, I'm not going to stay at the Columbus Inn or the Fairview Inn. I'm looking for a Fairfield Inn or a Hampton Inn or a Hilton, right? Like those are the places that I'm gonna look at. So one of the biggest things or advantages of having a franchise model is having that loyalty. So and that's something similar to Airbnb is, when there's somebody, customers that you have, they're going to go on to airbnb.com, they're going to search the area, and they're going to come into your property. So, like when you look at marketing, when you look at like the actual philosophy of short-term rental, there's so many similarities. One thing that I will say that I think hotels have an advantage is the consistency portion, right? So even us, like when we go and we're trying to book an Airbnb, we're thinking, oh, is it really going to be clean? Are they going to cancel on us last minute? What's going to happen, right? So when I'm talking to short-term rental audiences, one thing that I always say is like when you have a portfolio or you're trying to continue to scale, it's so important that the communities out there understand the importance of having that consistency. Because, to be honest, like I think that's the one thing that like traditional franchise hotels have over Airbnbs, right? Like even though we can't accommodate 15 people in one room or a whole family, people want to hang out in the living room, we can't do all of that stuff. The one thing we have is the consistency. And so like, one thing I always say is you guys have to create that consistency in order to steal some of that market share from hotels. So yeah, I mean, you guys have any specific questions on, like the difference between hotels, Airbnbs? I mean, we could definitely talk about that.
Yeah, no, I think there's a lot of commonalities overall. I was curious on the different systems and softwares that you use to manage and try to compare it to, even our portfolio. Do you have dynamic pricing tools and a PMS system in place? What do your operations look like from that standpoint?
Yeah, so what our PMS, it's really what's required of us. So with each brand, we use a different PMS software, right? So when we're looking at IG, for example, so Holiday Inn, we use a system called Opera. And so through Opera, we're able to come in, we're able to take the bookings, all of our credit card processing, for the keys for the rooms, like everything gets integrated into the software. So when we check in a guest, we put their name in, we check in the guest, we print the receipt, and then when we want to generate the key, everything gets integrated into the software. The good and the bad is that, because we have these franchises that mandate these, we're kind of required to have these processes. But one thing is that, like, there's options like Visual Matrix, or there's Auto Clerk, even the system that like Choice uses. All these systems are able to be white labeled. And so, when you guys are creating softwares, you guys can totally take these POS softwares and implement them into your Airbnbs or your short-term rentals and be able to keep it the same all the way around. So when now all of a sudden, when you have 10 or 15 units in one area, or let's say you have a 15-unit boutique hotel, you can totally use that and have somebody who's trained on that one software come in. Let's say you guys use the same software across the country. Somebody who's trained in Florida can totally go up to Denver and set up the whole shop, right? So you can rinse and repeat. And that's the beauty of this, right? Like when I'm looking to hire a front desk staff that has Holiday Inn experience, and I'm hiring them for my Holiday Inn, I want them right away, because I know they're going to be able to come in day one and they're going to know the system inside and out, right? So I think the beauty of all of this is like consistency. It's the same. It's rinse and repeat. And so, so our PMS system is that. And then as far as like dynamic pricing, there's so many management companies out there that we can utilize. But one thing that we do have is with our brands, we have like regional marketing guys that will come in, they'll talk to us, they'll do a rate shop every single day. We use something called a star report. So it's called an STR report. That gives us like the entire comp set in the area. So we're able to see what the prices are for the month for all of our competitive hotels in our market. And we get to choose the hotels that we want. So, when we have a limited service hotel, we'll look at the 4 or 5 other limited service hotels in the comp set. We get this data every single month, and we sit down and we rip it apart, right? Like we look, okay, the Hampton Inn, you guys use RevPAR? Do you guys use that? Yeah, right. So we look at the occupancy, we look at the ADR, we look at the RevPAR. We try to understand, okay, why is the Hampton Inn in our comp set, why are they decreasing the ADR, increasing occupancy? What are they seeing that we're not, right? And so, then the next month it's we start decreasing the ADR, and that's such a tricky game, right? Because you always want higher ADR and lower occupancy if you had to choose between the two. And so, if everybody starts dropping their ADR, then all of a sudden the whole comp set starts going down. So, those are the things that we're looking at every single week, every single day, every single month. We're really digging into that. As far as dynamic pricing, we use AI softwares that will give us like kind of the sweet spot. So it will take into consideration what's happening in the entire comp, what all the hotels are as they drop rates or increase rates. It will tell us that, hey, like a red flag will come up and it will say, hey, you need to increase your rate $3 to $5 tonight, right? And for when you have one unit, a single Airbnb, the $3 to $5 or $10 or $15, it doesn't make a huge difference. But the beautiful thing about like when you start to scale up in the short-term rental game and you have 80 units, $1 a day, $80 times 365, and all of that goes straight to the bottom line. It makes such a big difference. And the beautiful thing about like having hotels is there's so many expenses, right? So people listening are like, what? It's a beautiful thing. You have so many expenses. How does that make any sense? But it is a beautiful thing because there's so many expenses and it's priced according to those expenses. And if you're able to come in with a management company or asset manage those expenses and make it a little bit more efficient, just 10%, all of that trickles straight down to the bottom line and adds to your profitability, right? So example, like we bought a hotel not too long ago, and it was absentee owner, and we came in and all we did was we looked at the breakfast expenses. We came in, we looked at the breakfast expenses, and we just tightened up the screws on a few items in breakfast. So we sell 20,000 rooms a year. And when you tighten up breakfast for like 3 or 4 items, if you start saving 50 cents on 4 items, that's $2 that you're saving per room on breakfast expense. Now you times that by 20,000 rooms, all of a sudden you're saving $40,000 that goes straight to the bottom line. And you know, all your guys are so smart because they're listening to you guys all the time. But you know, when you look at valuation and you look at cap rate, you know, even at a 10% cap rate, you know, that adds 400K to your, you know, to your value. So it's huge.
Yeah, it's one of my biggest gripes with what we're doing in the single family space, because everything is based on the neighbor's house next door. So it doesn't matter how good of an operator JB and I are, you know, Susan across the street, her house is going to be valued based on the bedroom, bathroom count, how nice the renovations are. Doesn't matter that we increase NOI by 5%. So that's the main thing that is driving me towards, you know, wanting to move into multifamily at a high level.
No, that's so true. So let me ask you this. When you guys are looking at boutique hotels, right? So you guys are looking at like maybe 20, 30 unit boutique hotels. What are the cap rates that you guys see for boutique hotels?
Yeah, so I've always followed the rule of thumb of 10 being attractive, you know, but I would think that at a smaller scale, we would probably want to be ideally at 12. My thought process is just that from a time allocation, trying to get the brand up, building out the hotel, getting all the systems in place, we would want to maximize, you know, our total income. So I feel like as we go down in the total property value, I would want the percentage to be higher. What do you think about that though?
Yeah, I mean, I think, and that's exactly where we are, right? So when we're looking at our franchise hotels, we're looking between 8 to 12% on cap rates. And so, you know, the reason why I was asking that is because, you know, with the boutique hotels, one of the biggest benefits that you guys have is you're able to operate it from remote, right? You don't have somebody there to physically check you in. You don't have someone there who has to be there to give them extra towels, or, you know, just listen to all the complaints that's, you know, our guests are going to have, right? We all deal with it every day. But we have, and that's the biggest expense that we have. We have our front desk and our GM that's there every single day. That's going to be the biggest, you know, biggest piece of our payroll expense. And so, you know, we're still, luckily, the good thing is even with that expense, we're still looking at about 10% cap rate. So at the end of the day, those expenses are factored in to the cap rate. So, you know, I was just wondering, because I'm curious as to, you know, when I'm valuing that, I'm truly valuing the fact that no one has to physically be there, but is that really valued at the bottom line, right? I almost feel like it should be 14% because you don't have that expense. And we do have that expense. A lot of times what a good operator can do is come in and decrease that payroll. You know, for example, one thing is we have an employee that comes in from a shift. Usually shifts are like 7 to 3, and then 3 to 11, and then 11 to 7, right? But there's always going to be overlap. There's no way that, you know, one person's going to walk in through the door and the other person's going to leave. It's never going to happen like that. There's always, you know, things that need to be communicated, cash that needs to be handed over. So there's 15 minutes of overlap, right? And so a lot of times what will happen is we'll buy a hotel and we'll see that, hey, there's 30 minutes of overlap or 35 minutes of overlap, and we're able to decrease that, and that right away increases our cap rate, our bottom line, especially when we're selling. We're able to sell at the same cap rate, but, you know, at a higher value. So, you know, it's just something that I was curious about, if you know, the cap rates really reflect the value of having that, you know, autonomous management. So.
Okay. Everyone is ready to buy hotels. All the listeners, Aiden's ready, I'm ready. But like, let's focus on acquisitions. How are you acquiring these properties when you're not building or developing? Like, is there a Zillow for hotels? Do you have, a bunch of off-market connections? Where do you go to acquire these hotels?
Yo, good question, man. So let me ask you this. Where are you guys looking? You guys are looking at Zillow. And then what else? What else? Where else are you guys looking?
Yeah, Facebook market or Facebook in general, going to meetups, wholesalers, realtors, just making as many connections as
Yeah,
possible. We host a meetup once a month. We get leads from our podcast, just
I
anywhere and
love it,
everywhere.
man.
Yep.
I love it, dude. It's the same thing, man. What you want, what I want everyone to do right now, open up another tab, just type in hotels for sale. You'll get so many sites that just pop up. And so, biggest one, CBRE, LoopNet, right? Like LoopNet, even boutique hotels, people are looking LoopNet. So LoopNet, CBRE, Marcus Millchap, all of these big brokerages have realtors who specialize in hotels, right? And so, the biggest thing that we have to do is build that network of realtors, of community, get into the right rooms, get into the right spaces. And to be honest, a lot of the hotels that I bought are kind of just owner to owner, right? So when we start building these networks and you go to conferences and you meet other owners, you'll find somebody who's like, hey, trying to get out of the space now, or trying to level up, or trying to get into bigger properties, or this one is just too far away for me to manage. And you'll be able to get your foot in the door without the realtor, without that commission that has to be baked into the sale price, and you'll be able to get in for a really good price. So, I think the biggest thing to get started to buy hotels is call up these realty companies and ask all the dumb questions. Don't worry about it. Ask them all the dumb questions. Let them know that you have no idea what you're talking about. It's okay, because that's how we learn, right? So do that, you learn, and then you rinse and repeat, right? You ask all the questions, you get the P&Ls, study the P&L, look at all the expenses that exist, going from just one Airbnb to a 20 unit or a 30 unit. Now all of a sudden your payroll is higher, right? Like, you might not even have a payroll. It might be something that you're doing all by yourself when you have that one Airbnb just down the street. So learn, what is payroll? Oh, there's payroll taxes. Oh, there's payroll processing fees. Oh, there's trash, right? Like, now all of a sudden you have to do waste management. And that bill is a lot larger. What others? Like, if I know you guys are in Florida, I'm in Ohio, but we have to plow snow. So like every time it snows, I talked about this once, but before I used to pray for snow days, right? Like, you get off of school, it's awesome, snowball fights, like it's great. Now, dude, when it snows, I'm like, oh my God, that's like $700 per property. Like, it's gonna kick my butt today. And when you have 5, 10 properties, it starts adding up. So every time it snows, you have this snow plowing expense or salting expense. And you really get familiar with these expenses as you start just digging into it. So I guess the first step is really just start making those calls, dig into it, sign some confidentiality agreements and get the P&Ls, study the P&Ls, look at the ratio of the expenses to the profit. How much percentage is like this utility cost versus what I'm making, what percentage is my payroll cost, what percentage is depending on if the boutique hotel will offer breakfast or not, what percentage is that, right? So taking a look at all those things, and then once you start refining that, you go back and then you make some more calls, and you talk like something, and all of a sudden you'll get to a place where, again, you feel like, oh man, I didn't think about this, and then you go back to the lab, you study a little bit more, and sooner or later you'll find the right person that's willing to give you the right deal in the right location, and you can totally jump on that. And it's no different than buying a home. I promise you that. It's not that difficult. A lot of times the biggest issue is we psych ourselves out, but it's just like transacting on any other real estate, right? You have your closing costs, you have your realtors, you have your insurance, you have X, Y, and Z that you have to have in place before you close. You need your mortgage, and then you keep going. But the beautiful thing about having this like connection or this network is you'll even find people that are willing to do seller finance. And so, that opens up a lot of opportunity as well. So
Yeah, no, that was my next question, right? Because I'm a listener. I was listening to Blue Gems podcast. I heard Sujay. I paused like 3 minutes in because I got excited. I made an offer on LoopNet. The seller accepted. Who's my lender? How am I actually going to take this
yeah.
deal down? So let's talk about seller finance and cool ways that we can actually take these deals down.
Yeah. So there's multiple ways to get these deals, right? So because it's a business plus real estate, one of the biggest ones is the SBA loan, right? So small business administration loan. So we can tap into that. Another one is conventional loans. So all you need to do is do a Google search, regional banks in my area, and pick up the phone and just go down the list. Get a notepad, write down which one you're calling, and just go down the list and see if they're willing to lend in the local market for a hotel, right? So that's one. Another one is, like we talked about, some creative financing options. So seller financing. So a lot of times what you can do is you can talk to the seller. Let's say this deal is, $2 million. For $2 million, you have to put about 25% down. So we're looking at $300,000 as a down payment. Now, if the seller is willing to come in and give you $150,000 as the down payment, now all of a sudden you only need $150,000 to meet that gap. And so depending on where we are financially, we can negotiate with the seller. Sometimes it might make sense to even increase the purchase price to be able to get a little bit of seller financing, right? So a $2 million property, all of a sudden, if you can afford to pay 2.2 million and then get $300,000 of seller financing, now all of a sudden, you've almost met whatever down payment needs are needed for the asset, right? And obviously, trust your numbers. You have to do the underwriting. It has to make sense. It has to fit in your model. So, I know a lot of people are really excited for deals, and they're willing to kind of justify the numbers to make the deals work. And when you get seller financing, it's exciting, but trust your numbers, make sure it fits. But there's a lot of creative things that we can do in order to get this. And then the last thing is, like, when we get into bigger hotels, you can totally tap into non-recourse loans. So when you tap into non-recourse, what you can do is you can syndicate these deals. A lot of times it's kind of difficult to syndicate one Airbnb, but when you get into the hotel space, it becomes so much easier to syndicate it because the cash flow exists. The cash flow is so strong that you can afford to pay your investors, 8% pref return and still have some money to take home and still have upside when you sell the property. And you can really see a lot of wins at the end of 5 years or 6 years or 7 years. And so a non-recourse loan will help you do that because you don't have to personally guarantee the loan. Your investors don't have to personally guarantee the loan. So they truly come in as a limited partner with no risk other than just their investment. So I think when you get into the hotel space, it just opens up so many opportunities, everything from like financing to the way you can structure the deal to get your foot in the door. It's pretty sick.
Man,
Gems
that's
on
exciting.
gems.
Yeah,
Gems
I'm
on gems,
about to make
baby.
some offers when we get off here. So,
Yo, make sure you keep me in the loop, man.
no, I love this.
We're selling all of our single families to get into hotels.
No, I mean, and with that being said, like, when you do scale up, sometimes you do have to shave off a little bit of returns to scale, right? And this
True.
is something that we were talking about right before we got on the call, is like, the balance of, operations versus like the headache of operations versus growth and scale and all of that, right? And so, when you have a bunch of single family homes, a lot of times the profitability exists. I mean, it's better a lot of times than, having 80 units under one door. Sometimes it is. It's just the way it works, right? But the trade-off is there's a limit to how much you can scale, and it's hard to find 50 units in like 3 or 4 neighborhoods in the same area, right? But so a lot of times what happens is your 50 units are spread around all over the state, and you can't be at all 50 units at one time. But when you scale and you have that, sometimes you trade off a little bit of the profitability, but now all of a sudden you could be at 50 different hotels in the same time that it takes you to be at 50 different single family homes, right? So there's a little bit of trade-off, and we all have to assess our goals. And if that's not really the goal, if we're happy where we're at, we're not trying to scale too much, then it might not make sense, right? And we have to constantly assess, see what the market is, see what's going on, and that's what it means to be an entrepreneur, to think on your feet, to cut left, cut right when it makes sense. So
100%.
Yeah, no, I love that. Let's hop into the formal questions, Aiden.
Absolutely. So let's say I just learned about hotels. I'm on LoopNet trying to get my first deal. What would be your number one piece of advice for me?
Ooh, number one. Okay, so let me ask you this. Are we looking at boutique, or are we looking at franchise, or both, or either?
Let's start with boutique first.
Boutique. Okay. The first thing that we want to look at is, try to, obviously we got to look at the pictures, right? We got to see the age of the hotel. A lot of times with single family homes, it may not matter as much because, because just the way it is, like, people are living in the home, they're taking care of it. Something breaks, like, no one wants to live in a place where there's a broken tile or this or that or whatever. So they're taking care of it as if it's their own, because it is their own, right? But what happens is when you have a hotel, you want to see that how it's maintained. So you want to take a look at the pictures. You want to notice the age of the property, because when you have real estate, a lot of times what happens is the older it is, there's things that are happening inside the walls, under the ground, that may not be apparent to our eyes. And a story with that is, I have a property that's about 25 years old right now. And on the third floor, we had a small crack in our stucco. And every time it rained, I guess some water was getting into the stucco. And we didn't know, but I guess years down the line, what started happening is the stucco started bubbling. And so the stucco started bubbling, and it started happening on one side of the wall of the building. And then it started happening on the other side of the building. And as one of our staff members was kind of driving, in and out, they noticed this. And we took a look at it, and we had to have somebody rip out the entire wall and rebuild it. And obviously, if it impacts our, operations, like, that's a loss right there. Plus, obviously, the cost of the repair, the cost of the renovation. And we found out, like, all of the insulation, all the way from the third floor to the bottom, all of it was like wet and molded, and it just wasn't a good scene. Had to rip it all out, re-stucco the whole thing. Luckily, like, the foundation was still there, and it was still strong. But had it have sat for another couple of years, like, who knows what would have happened, right? And that doesn't happen in brand new properties. That doesn't happen in properties that are 3, 4, 5 years. Well, rather, it's not as common in properties that are 3, 4, 5 years old. So the first thing that I'm looking at is the age of the property, how it's kept, how it's maintained. And then the second thing that I'm doing is I'm doing the confidentiality agreement. I'm getting the P&Ls. So the beautiful thing about hotels is they're already operated as a short-term rental, versus, when we go in for a single family house, we might be dealing with the owner of the house, right? Like, the people who are owner occupied, it's been their home, they've raised their kids there, and they're selling it to us. Now we have to get on AirDNA and see, like, what is my forecast? What is my pro forma here? But when we're buying a hotel, you have years of financial data. It's been operating as a short-term rental. You can take a look at what 2021 did, what 2022 did, and what 2023 is doing so far. And that is the most underrated thing about buying a hotel. Going into it day one, that if you're able to operate it just like the previous owner, how much money you should be making, how much revenue should be there at the property. And so, I think that's the most important piece of this, is being able to pull out the P&Ls, being able to study that. So you pull out the P&Ls, you create a pro forma. So you say, okay, this is how it's managed. These are the expenses. This is what I know that I can cut the experience down. This is what JB's telling me, like, hey, like, payroll is a little high, or this is a little low. okay, like this is what we can do. So, crank the screws, make that, maybe 3 years down the line, let's say you're going to get to like optimal efficiency. What are your numbers going to look like? What are the profits going to look like? And then what I do is I discount that like 5% or 10% or whatever it may be, right? So I discount it, under promise, over deliver, always. That's the motto. And create your pro forma, right? So create your pro forma. And then if the numbers make sense, then you pick up the phone and you call them and you say, what's the deal? What's going on? You find out what the deal is. Find out, the biggest thing is like find out the pain points of the seller, right? So once we know the pain points of the seller, maybe they have a 1031 exchange, or they're looking to do a 1031 exchange. They found another property. They want to move quick. Maybe they're incentivized to do a quick closing, right? And you can negotiate down the price to get that quick closing. So, pick up the phone, call the realtor, call the owner, whoever's listed it for sale. And then I guess the next step would be, get your financing in place. So you want to start calling your lenders, figure out, are you open to conventional loans? Are you looking for a CMBS loan, which would be a non-recourse loan? If you're looking for that, then you got to call a broker, a mortgage broker. So you got to get them involved. If you want to go conventional, go SBA, you call up your local banks, you let them know, hey, these are my financials. What can you do for me? So get your financing in order, right? And then what you do is you put in LOI is kind of happening at the same time. You start negotiating the purchase sale agreement. Obviously you want to have an attorney look at that stuff. And then once you get into contract, then you want to go, right? You want to go visit, you want to be there, you want to do your walks. If there's employees there, hopefully you want to try to be able to build a good relationship with your employees, because the worst thing that you want to happen is turnover on the payroll, on like the employee side. So, that's kind of the process, very similar to, what it would be, I think, if it was a multifamily asset, office space, self-storage unit. You're going to underwrite, you're going to get your financing, you're going to go do a site visit, you're going to look at these things. So, obviously we can dig into it more, but, in the interest of time, we keep going. But
that was the hotel masterclass in 60 seconds.
In 60 seconds, baby.
Times 3.
Right.
So in our space, the short-term rental Airbnb space, there's a lot of talk in the media about the Airbnb bust. I'm sure you've heard about it. Don't know if that is the same in the hotel industry, but I wanted to get your opinion on the current state of the hotel market and what we're looking like going into 2024.
Yeah, no, absolutely. So I think, I'm actually getting really excited. It's a great time to get into hotels because, really two reasons right now. Because, what happened during COVID, obviously the hospitality industry got absolutely obliterated. Like we got smashed in the first half of 2020. It was tough, but we made it. We weathered that storm. And, what happened was all these other travel pieces like airlines, rental cars, their prices shot up like crazy. But for what happened with hotels was people were still under this impression hotels during COVID are supposed to be super cheap, and they were still expecting really low prices for hotels. And all of the expenses started to go up, like payroll started to go up, energy costs started to go up, all these uncontrollables, replacement costs. So building costs went up like crazy. But the room prices weren't going up as much. And so, what happened was it had to slowly ramp up because of this whole feeling or atmosphere that was kind of happening across the country. But with that being said, as things are starting to trickle down, like people are talking about, multifamily rents are going to, rent increases are going to start decreasing. Rents might even decrease in the next year or so in certain markets. I mean, Bigger Pockets podcast just put out something like that, a couple weeks ago. But there's all this data around multifamily, rents are going down. But with hotels, it's not happening because we're still catching up to all the demand and all of the inflationary increases. And so hotels are going to continue to go up, not as much as 2021, but still continue to go up in ADR. So there's still a lot of revenue, and it's a great hedge against inflation still. The problem that's happening right now is the capital markets are definitely running a little bit dry. And, hotels definitely more risky than investing into a single family home or investing into, a self-storage, facility, or even a multifamily in a sense, right? It's a higher risk, but higher reward. And so the capital markets are becoming a little bit dry. And what happens when you have a hotel is you have to do a renovation every so many years to keep the property up to date. And so an example is right now, like we have a property, we have a renovation that's happening right now. And my bank had told me, they're like, don't worry, we got you. We're going to take care of the renovation. It's, Marriott is requiring it. If we don't do it, then we're going to lose our license. So like, it's almost always certain that like our bank is going to give us the loan. Now the terms might not always be favorable, but they're going to give us the loan to do the renovation, right? It's going to increase the value of the property and all of it, right? So, but all of a sudden, right before the Silicon Valley Bank news hit the market, my bank started making excuses, and they're like, oh, I don't know if we can do it anymore. And then boom, the news hit the market, and they, then they felt confident to say, hey, like we just won't be able to do it. We don't have the liquidity to do it. We're over invested in real estate. We can't do it for you right now. And so now I've ordered all of the furniture. It's $1 million renovation. I've ordered the furniture. It's sitting at my hotel. I have contractors ready to install. I'm ready to go. This was a 3-month renovation. We were going to flip the property really quick, keep it in operation. All of a sudden, I don't have a loan, right? So now I have to be able to go out to the secondary market, find a secondary loan, or, finance it in-house. There's so many options, right? We decided to, kind of take care of it in-house. Luckily we were able to do that. So we're doing the renovation. We're going to finish it up here soon. Option is to, refinance later. But, my point is that, luckily ours was $1 million renovation. Now, if there's projects that need larger capital, injections, or they're not able to finance it from in-house, it's going to create a lot of opportunity. Also, the hotels, when you have a single family home, you can get maybe a 20-year term on your property. What happens with hotels is you're typically not going to see a 20-year term. You're going to see 20 or 30-year amortization of your loan, but the term of it will only be 5, 7, or 10 years. And so people who had this, great interest rate, 3%, 4%, all of a sudden their loans are going to come due and they're going to want to refinance, but it's not the numbers, though it's profitable, though it's performing, the numbers may just not make sense at the new price point, right? At the new cost of the loan. And so, they're more incentivized to sell it, get it off the books, wait a year, maybe they'll do 1031 exchange, whatever it may be. So I really think there's going to be a lot of opportunity to get into the hotel space. It's still going to continue to be profitable because all the expenses have gone up. The, prices have not gone up in comparison. So they're going to continue to be driven up. And it's a great hedge against inflation, right? It's the real estate plus business. I mean, it's the biggest flex that we have in the hotel space, right? So we're paying down our mortgage. We're doing P&I payments 5 years down the line. We can, recapture that equity. Plus, we have that everyday cash flow that's coming in. So similar to Airbnb, it's the same thing. Unless you arbitrage it, you have the real estate plus the business. And so, I think it's going to be an awesome, next like 6 months to a year for people who are trying to get into it. There's going to be a lot of opportunity. Syndications are just now becoming a thing in hotels. And so you can really be kind of one of the first to get into the space. So
Amazing, man. Love it. And then for the listeners, if you could leave one last gem, it could be about hotels, real estate, syndications, or just life in general. What would you want to leave them?
So I'm a big Kobe guy, like Mamba mentality, Mamba forever. And I love sports as well. And so, just recently, for those of you that watch sports, like Giannis was talking and he's like, this year's not a failure or whatever, right? And so, like a lot of people have been relating that back to something that Kobe said. And it's, real estate is hard. It's not easy. especially in this day and age, like interest rates are going up. It's tough to get a deal. Not as many people are scared to list their properties right now because they want top dollar, but they're not able to get top dollar because of the rates and the cost of ownership. And it's hard, right? It's hard. But no one said entrepreneurship was going to be easy. Everyone online talks about like freedom and lifestyle through real estate and entrepreneurship, but it takes time to get there, right? And the biggest thing that I like want to tell people, and something that I talk about all the time, is like never give up. Like just because you called someone today and you didn't get the deal, just because you put an LOI and someone beat you, like doesn't mean that that same thing is going to happen tomorrow, right? Like Edison, it took him 1,000 tries to get the light bulb. No one calls him a failure, right? Everyone calls him a success. Like instead, like he's talked about hundreds of years later because of what he did, right? And so, the biggest thing is like just because you fail on Monday, it's only a failure if you don't wake up on Tuesday. And that's what Kobe said. Just like keep going, keep grinding, like use these platforms that we have, like social media, Blue Gems, like reach out to us or anyone else who've like gone through all of that and have found some success. I'm not going to say I'm like super successful or anything, but found some success, and we're continuing to grow every single day. Look at that and use these resources and just keep pushing, and don't give up, man. That's the biggest thing. Show up and don't give up. So
Incredible, bro. Yeah, I'm gonna go make some offers. Now I'm about to go dunk on somebody. I love
yes,
it.
sir.
Now, Sujay, where can people find you?
Yeah, I mean, feel free to hit me up on social media on Instagram. SUJMEHTA, Suj Mehta is my tag on Instagram. Hit me up on there. Feel free to DM me. I know I talked really fast. There's just so much to unpack. Like if you're in the Houston area, like let's hang out. Let's grab some coffee. But feel free to reach out to me on Instagram. We have a YouTube and TikTok and all that as well. So, yep.
Appreciate
Amazing.
it, brother.
What
What
an
an
episode.
episode. Love it.